Ever wondered how super investors like Warren Buffett and Bill Ackman choose their stocks? They are the titans of investment, managing over a staggering $100 million in assets, and here's the twist: they are bound by law to disclose their portfolio moves every quarter. This level of transparency, while seemingly daunting, provides an intriguing window into their world, offering insights into their investment strategies. It's like a treasure map, leading us to understand how they pick their stocks, how they make their moves, and most importantly, how they think. This isn't just about the money, it's about the method, the strategy, the mindset that sets these super investors apart. So let's dive in. Let's decode the secrets of their success. In this video, we delve into the top 10 most frequently bought dividend stocks by these super investors in Q1 2024. The game is on. Are you ready to play? Starting with UnitedHealth Group, a popular choice among super investors. Despite kicking off with a modest yet stable dividend yield of 1.44%, UnitedHealth Group has carved a path of impressive dividend growth that's hard to ignore. This healthcare behemoth has consistently shown strong financial metrics, displaying robustness in its operations and financial management. The company's resilience and ability to generate substantial cash flows have played a significant role in its dividend growth story. It's not just about the dividends, though. UnitedHealth Group's overall performance and potential for future growth also make it a compelling pick for these heavy hitters in the investment world. The company's diversified business model, coupled with its strategic investments, continue to fuel its growth, adding to its appeal. So it's not just about the now, it's about what's to come. No wonder UnitedHealth Group is a favorite among the big players. Next up, we have the technology giant Apple. This powerhouse is known for its massive share buybacks, which can be seen as a way to return wealth to its shareholders. But let's not overlook its dividends. While Apple's starting dividend yield sits at a modest 0.52%, this tech titan has a history of significant dividend growth. This growth, coupled with its strong financial performance, are key indicators of its commitment to rewarding investors. It's not just about the immediate yield, but the potential for that yield to grow over time. And with Apple, the potential is substantial. The company's financial strength, underpinned by its innovative product range and loyal consumer base, provides a solid foundation for this growth. So, while the initial yield may seem small, the long-term view tells a different story. Apple's massive share buybacks and financial strength make it a top pick. Moving on to another tech giant, Microsoft. While some investors are drawn to stocks with high initial yields, Microsoft dances to a different beat. This tech behemoth's approach centers on dividend growth over high starting yields. With a starting yield of just 0.87%, Microsoft may not appear enticing at first glance. But don't be fooled. The company's robust financials and consistent share buybacks are testament to its steady growth and profitability. Microsoft's financial health is not just robust, it's rock solid. A consistent track record of strong earnings and revenue growth, coupled with a healthy balance sheet, gives the company a financial resilience that is enviable. But the cherry on top is Microsoft's share buyback program. By consistently repurchasing its own shares, Microsoft is not only returning capital to shareholders, but also reinforcing the value of its stock. Microsoft's strong financial health and steady dividend growth make it a coveted stock. Let's not forget Zoetis and Starbucks, both showing impressive dividend growth. Starting off with Zoetis, this company may not have the highest initial yield, sitting at a modest 1%, but it's the growth that's truly remarkable. Over the last decade, Zoetis has been growing its dividends at a compound annual growth rate of nearly 20%. That's right, a 10-year KGR of 19.64%. Its 5-year CAGR is even more impressive at 21.4%, showing that this company is not slowing down. Zoetis is a shining example of why looking beyond the starting yield is essential. With such exceptional growth, those dividends can really add up over time. Now moving on to Starbucks. With a starting dividend yield of 2.82%, it's a bit higher than Zoetis. However, Starbucks has also demonstrated strong growth, which is key for long-term investors. Despite facing some financial challenges in recent years, Starbucks has managed to consistently increase its dividends, showing its commitment to rewarding its shareholders. The company's resilience and ability to adapt to changing market conditions have allowed it to keep delivering value to its investors even in tough times. Both Zoetis and Starbucks have shown that they're not just about the initial yield, they're about growth, they're about resilience, they're about delivering value to their shareholders over the long term. and that's what makes them such attractive options for super investors. These are companies that have not only shown strong performance, but also have promising prospects for future growth. So, when considering where to invest, remember to look beyond the starting yield, consider the growth, consider the company's financial health, consider its performance, and consider its prospects for the future, because it's often these factors that can make the biggest difference in the long run. Both Zoetis and Starbucks offer promising prospects for dividend growth investors. Next on our list are Union Pacific, Visa, and Alphabet. Let's begin with Union Pacific, a stalwart in the railroad industry. With a starting yield of 2.21% and a 10-year dividend compound annual growth rate, or KGR, of 10.53%, Union Pacific continues to chug along as a dependable choice for those seeking consistent dividend income. Its performance is backed by solid financials and a well-established market presence, making it a firm favorite among super investors. Moving on to Visa, a leader in the payment technology space. Despite a lower starting yield of 0.75%, Visa shines with its strong dividend growth rate. The company's financial health is nothing short of excellent. It benefits from the burgeoning digital payment market, a trend that shows no signs of slowing down. Therefore, Visa's potential for future dividend growth and its ability to capitalize on digital payment trends make it a compelling choice for investors looking for growth and stability. Last, but certainly not least, we have Alphabet, the parent company of Google. Alphabet is a recent entrant into the dividend-paying club, starting with a yield of 0.45%. While this yield may seem small at first glance, Alphabet's robust financials and minimal debt indicate a significant potential for future dividend growth. Alphabet's dominant position in the digital advertising market and its ventures into cloud computing and artificial intelligence bode well for its future performance. Consequently, Alphabet offers an intriguing investment opportunity for those willing to bet on its dividend growth potential. In summary, Union Pacific, Visa, and Alphabet each provide unique investment opportunities. Union Pacific offers stability and consistent returns, Visa provides robust dividend growth coupled with excellent financial health, and Alphabet presents an exciting prospect for future dividend growth. These three companies offer a mix of stability and growth potential for savvy investors. Lastly, we have Aon and Philip Morris International. Aon, the global professional services firm providing a broad range of risk, retirement, and health solutions, offers a low starting yield of 0.76%. But don't let that number fool you. What makes Aon stand out in the crowd is its remarkable free cash flow growth and consistent share buybacks. This combination of factors makes Aon an appealing option for investors focused on dividend growth. Now let's shift gears to Philip Morris International, the leading international tobacco company. Philip Morris distinguishes itself as the highest yielder on our list, boasting a starting yield of 5.14%. It's a figure that's hard to ignore, particularly for those investors seeking substantial dividend payouts. However, it's essential to keep in mind that investing is rarely a one-dimensional game. While Philip Morris's high dividend yield may seem enticing, the company faces challenges with its free cash flow covering dividends. It's a reminder that a high yield isn't everything, and potential risks must be assessed alongside potential rewards. Investing in dividend stocks is not just about chasing the highest yields. It's a complex puzzle where each piece plays a crucial role in the bigger picture. The strength of a company's financial health, the consistency of its dividend growth, and its overall performance are all part of the equation. Aon, with its strong free cash flow and consistent share buybacks, highlights the importance of looking beyond dividend yields to the company's financial health. On the other hand, Philip Morris, despite its high yield, reminds us of the potential risks that can come with companies struggling to cover their dividends with free cash flow. While Aon and Philip Morris have their unique strengths, they also underline the importance of considering all financial aspects. It's about balancing the allure of immediate gains with the stability of long-term growth. And that, dear friends, is the art and science of investing in dividend stocks. So there you have it, the top 10 dividend stocks chosen by super investors in Q1 2024. As we've explored, these stocks are more than just high yielders. They are the result of careful selection by some of the world's most successful investors, who have demonstrated an exceptional ability to identify high-performance assets. Let's recap. UnitedHealth Group, despite its low starting yield, has shown impressive growth and strong financial metrics. Apple and Microsoft, both renowned for their massive share buybacks, also have histories of significant dividend growth and robust financial performance. Zoetis and Starbucks have demonstrated exceptional dividend growth, with Zoetis boasting a 10-year compound annual growth rate of nearly 20%, and Starbucks offering a solid starting yield of close to 3%. Union Pacific, Visa, and Alphabet have all proven to be solid choices among dividend-paying stocks, each with its own unique strengths. From Union Pacific's decade-long dividend growth to Alphabet's significant potential for future growth. Aon and Philip Morris International round out our list. Aon with its strong, free cash flow growth and consistent share buybacks, and Philip Morris, the highest yielder on our list, despite challenges with free cash flow covering dividends. The common thread here? Each of these companies demonstrates not just high dividend yields, but also significant dividend growth, strong financial health, and overall solid company performance. These are the attributes that super investors look for, and they are the factors that can help you build a robust and profitable portfolio. But remember, successful investing is not just about following the crowd, even if it's a crowd of super investors. It's about understanding the financials, recognizing the potential for growth, and making informed decisions based on a comprehensive analysis of various factors. So, while these 10 stocks are certainly worth considering, they should serve as a starting point for your own research. It's your money, after all, and no one cares more about its growth than you do. Remember, successful investing is not just about following the crowd, even if it's a crowd of super investors. It's about understanding the financials and making informed decisions. Happy investing. Before we wrap up, we'd like to hear from you. Do you agree with our super investors picks? Are there any dividend stocks you believe should be on this list? Let us know in the comments section below. We always value your insights and opinions. And if you found this video informative and helpful, please give it a thumbs up. Your likes help us reach more people and provide them with the same valuable information you've just received. Also, don't forget to hit that subscribe button. By doing so, you're not only supporting our channel, but you're also ensuring that you don't miss out on any future content. We've got plenty more insightful videos coming your way, so stay tuned. Thank you for watching, and remember, the key to successful investing is informed decision-making. So, keep learning, keep growing, and most importantly, keep investing. Don't forget to subscribe and join our community of informed investors. Happy investing!